Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Chan, you're watching Indian Open. Let's go straight to the headlines. The US Federal Reserve cut interest rates by 25 basis points last night with the caveat that it was not the beginning of a long easing cycle. India's fiscal deficit stood at 61.4% of the budgeted FY20 target at the end of June. That's lower than the same period last year, though. Invesco Oppenheimer Fund will acquire up to 11% stake in Z Entertainment for over 4,000 crores, giving the promoters a much-needed fillip to deleverage the balance sheet. And mobile marketing company Affle India's IPO saw a bumper response from investors. The 459 crore issue was subscribed 86.5 times on the final day. In top news, the US Federal Reserve cut policy rates by 25 basis points as an insurance against downside risk. Chairman Jerome Powell was quick to announce that this was not the beginning of a lengthy easing cycle, but added they will not be the last rate cut either. Markets did not react too well to the commentary. Kathleen Hayes of Bloomberg News reports.
Another tough day for Jay Powell. The reaction, you don't want to start your press conference and you see stocks plummet, but as Mark Cranfield just said, the markets were setting themselves up. They expected this aggressive Fed statement, signaling more rate cuts. And what we got from the Fed's policy statement, what we got from Jay Powell, is that they are ready to take out, or they have taken out, a rate cut that's an assurance against downside risk. Let's remember, a lot of the recent economic data on spending in the U.S. from consumers and jobs have still held up. And he did say it's not the start of a long easing cycle, nor did he say, in fact, he made it pretty definite to say that this is not necessarily one and done. Let's listen to Jay Powell at the press conference earlier.
Let me be clear. What I said was it's not the beginning of a long series of rate cuts. I didn't say it's just one or anything like that. What I said is when you think about rate cutting cycles, they go on for a long time, and the committee's not seeing that. They're not seeing us in that.
And important, the Fed in some ways is in uncharted territory. How often have central banks like the Federal Reserve had to have policy so impacted by a global trade war that the United States is one of the two big parties in? This is putting a shadow over U.S. growth, over global growth. Let's listen to one of the things that came at the top of the policy statement. In light of the implications of global developments for the economic outlook as well as muted inflation pressures, the committee decided to lower the target range for the federal funds rate to 2 to 2.25%. People say, you know what? And they didn't put inflation first this time. They're really worried about the trade war and the global slowdown. Now, another thing that happened here, of course, 2 high-profile dissents. 4 Fed Bank presidents are voters right now. 2 of them dissented, Esther George from Kansas City and Eric Rosengren from Boston, because they don't want to cut rates now. They don't see a need for the insurance cut. They're worried about excesses in the financial system. The FOMC did end the balance sheet runoff a little bit early. The quantitative tightening is over. Why? Because it doesn't make sense to start cutting rates to stimulate growth while you're running off the balance sheet, which kind of is a little bit of tightening. So that's consistent. Not surprising, but significant.
Well, joining us on the phone line is James Glassman. He's managing director and head economist for commercial banking at JPMorgan Chase. Joins us from New York. James, thanks so much for staying up this evening for us out here at Bloomberg Quint. Good evening to you. What did you make of this? There were a couple of unexpected things. I mean, one good thing that I thought the Fed chair did was not open the door for the market to expect that what's happened last night or last evening for you will be something that will happen consistently over the rest of the year.
Yeah, I think that's right. I mean, this feels more like an insurance move. I mean, I thought one of the most interesting questions was from the Bloomberg reporter, Mike McKee, who said, you know, this feels like the Federal Reserve has a hammer looking for a nail. And I think the problem is the market has been anticipating a series of moves. And so this is a difficult situation for the Fed because the market's already there. The market's already expecting like 100 basis points of easing over the next course of the next year. And the Fed had to try to communicate that this is really not about a worry about the U.S. economy falling apart. It's more taking out a little insurance, which is it's unusual for the Fed to do this, particularly when it would make sense if the Fed had really tightened aggressively, as they did in 1994, 1995. They keep referring back to that period. This is not like that. So I think the market was a little surprised because this doesn't sound like a Fed that's got in mind the series of moves they're going to be doing. And so you're going to have to wait and see. I mean, the data are going to have to show you some evidence that the economy is falling apart. The problem is the U.S. should be slowing down because you can't keep growing faster than your underlying trend when you've reached full employment. So some of this is natural. So I think people are going to be a little confused for a while. They're trying to figure out what is it that the Fed is watching and going on. And for sure, the news abroad has been somewhat disappointing. We don't really know whether the slowdown in the U.S. and industrial activity is really the trade war, or is it idiosyncratic things like the auto industry, the energy sector, the Boeing phenomenon. These are all things that have nothing to do with trade. So I think the market was taken aback by the caution from the Fed today.
Okay. Yeah, well, I somehow think that, I mean, I've now stopped giving due credence to market moves because they change at the whiff of a move from the Fed as well. So my question to you, to James, is this, that there are two arguments to what the Fed should do or can do or why it didn't do what it did yesterday or what it didn't do yesterday. One side is a sect of people who believe that being data dependent is better, and he said that he's data dependent because we do not know which way the US economy will move based on the basis of the trade war. The other side says that, hey, inflation is low and the dollar is strengthening when you go out and do what you're doing. So how do you justify that? Now, I don't know which side of the argument do you lean on?
Yeah, I don't know. I don't buy the inflation argument because I think there's many. There are specific measures that look like it's on the low side, but there are a lot of other measures that are showing. Inflation is very noisy, and I think there's some special things going on. The Fed was talking about that a couple months ago, and they don't talk about it anymore. I myself am. I think it's. Central banks tend to just be data dependent. They want real evidence before they actually take action. You could argue that it does make sense to be thinking about risks. The problem is when you want to take out insurance on the basis of some uncertainties that you worry about, that's very subjective. You don't know. The uncertainty and risks are all in the mind of the beholder. And I personally am sympathetic with the president of the Boston Federal Reserve, Eric Rosengren, who objected today, because I think that the central bank's job, once they get the economy out of recession, a central bank's job ought to be to try to avoid creating overheating situations where they eventually have to come in and step on the brakes, and that causes problems for the new recession. So I think the problem is the market is sitting here trying to balance. They see the Fed under a lot of pressure from the political side, and I think maybe people see this slowing going on in the U.S. and they think that must be signs of trouble coming. And so I think, personally, I think when there's all kinds of uncertainty you could be worried about, and I think for that reason, a data-dependent policy probably makes the most sense, particularly since policy is not that far out of line right now. So it's not like there's great danger brewing.
Okay. Well, you seem to be in sync with Jerome Powell. Just one final question, James, and that is on how have you seen the earnings shape up thus far? Because what the markets will do will not now be a factor of necessarily what the Fed does, but what the economy and the earnings picture throws up as well. Do you think the U.S. markets are in a spot of bother, or are they, for lack of a better word, shipshape?
They're okay. I think the earnings have been very strong for the past year because of the U.S. tax cuts. So that gave earnings a big boost. Now earnings have slowed down a little bit, but I think the stock market's okay. The only problem for the stock market is that the bond market, interest rates have come down a fair amount, and the market may have to rethink some of this, in which case, we may not see very exciting trends for the next several months from the equity market. But I think the equity market's fine, particularly if you believe that the global economy, the expansion continues, inflation stays low everywhere. That's just an ingredient for a good, solid performance in the equity markets, I think, down long term. Once we get over this adjustment to what the Fed got in mind, and I think interest rate markets have probably gone a little bit too far, so they had to back up some, is my guess.
Interesting. Okay, James, really appreciate you staying up and talking to us out here at Bloomberg Quint. Thanks so much.
Yeah, Good. Bye-bye.
That's the view from James Glassman of JPMorgan Chase. Doesn't believe that the Fed did anything untoward. Now, the proponents of the move, there are people who believe, like Howard Marks, for example, believe that all that's happening is not good and rate cuts don't necessarily spur the economy. Maybe that argument holds water too. But the US markets did get a bit trading disappointed because I think people were positioning themselves for at least a dovish commentary, if not more rate cuts, and that didn't happen. So the US markets came off. It could well be a day's move, really. I'm no expert on the US markets, but just looking at how the markets tend to react to every second piece of news, and Friday has got large economic data coming out from the US, you may well have the markets reacting otherwise too. Asia, in the meantime, is starting off okay. So about 1%, or less than 1%, actually, 1/3% for the SGX Nifty. The others are mixed bag as well. So nothing too dramatic when it comes to the Asian screen as well. Quickly tell you what's lined up for India. We had a decent outing in trade yesterday. Let's see if that holds. So that 11,050, 11,000 mark remains a key monitorable. But the key things that would probably drive the mood and the sentiment in the markets today. Not too much in terms of Nifty results, only Bharti Airtel. So that's one, yes. But the broader end of the spectrum has some set of fairly interesting numbers. You'll have JK Tyre, Raymond and Tata Power come out with numbers. Commentary from that would be important. Prestige Estates, CEAT. Remember, after Apollo's numbers yesterday, all eyes on JK Tyre and CEAT and what they do, as well as Dalmia Bharat, because cement companies by and large have come out with good numbers, especially in that geography. And then the consumption names, right? This is a big day for consumers today. Marico, Godrej Consumer Products, both come out with numbers. Very, very important to see what's the kind of volume growth numbers they come out with. Agam was saying that the others haven't quite disappointed, so it'll be important for Marico and Godrej Consumer to come out with a half decent number to keep the sentiment on the street going. So do watch out, big earnings day today. Just very quickly, the stocks to monitor. Z Entertainment, I won't dwell too much on it because Sajid will, but remember, the news is that the Invesco Oppenheimer Fund, Developing Markets Fund, will acquire up to 11% stake. Promoters will sell that stake for 4,224 crores. This brings it to roughly a price of 400 per share, but it's a financial investor. We'll talk more about it in just moments from now. Watch out for Z today. Watch out, they've of course initiated a process for divesting key assets as well. Watch out for Eicher Motors. Results are below estimates. The net profit got boosted by a higher other income, but 19% volume decline in the big boy Royal Enfield, and that has impacted financials. That's a big one. Let's see how Eicher reacts today. Ashok Leyland, a mixed bag. The revenue missed estimates, but the margins were a beat. This was because the decline in raw material prices aided the margins beat. So do watch out for Ashok Leyland as well. You probably take a good number. Let's wait and watch if the market reacts positively. Care ratings, abysmal numbers really. Revenues down, net profit down, EBITDA down, and margins contracted so badly. 21% versus 48.6%. It's a illiquid stock but might react. Last but not the least, Reliance Capital. They've put out a release saying that the company's made the repayment on the due dates. Outstanding amount on the commercial paper side stands at zero versus a peak of 3,500 crores. It's difficult to really give a long-term positive view on this one, but maybe the markets could react positively. However, let's tell you what's lined up on First Word today, a collection of the top editorial stories. Sajid Mangat first tells us why the Essel Group promoters have to do a lot more to repay their dues. Then Yatin joins us to take us through Eicher Motors' performance in the first quarter and why the pain's not going to fade anytime soon as we prepare ourselves for the auto sales numbers getting in today. And then Nikki joins us to talk about the companies that stand to gain from the government's thrust on water infrastructure. First up, Subash Chandra and his family have entered into an agreement with Invesco Oppenheimer to sell 11% stake in Z Entertainment. The deal, done at a premium of 10.5% over yesterday's closing price, will fetch the promoters 4,200 odd crores. The entire amount will go to the mutual funds which hold the pledged shares. Sajid Mangat's here to take us through the details. Sajid, at one stage, the promoters have to garner at least another 8,000 odd crores or some sum. This is not a done deal as yet. What have you made of it?
So, the promoters were supposed to get 11,000 crores and that's the amount that includes principal interest and the upside which they had promised to the lenders, which is primarily mutual funds and NBFCs. Mutual funds itself were supposed to be paid around 8,000 crores with Birla, Kotak, HDFC having a large exposure there in mutual funds. This is the first tranche of transaction which gets them nearly 4,200 crores and which they will be able to pay to the lenders who had shares of Z pledged against or as collateral for the debt paper. Now, it may not be enough for them, because Z promoters are banking entirely on the fact that they will be able to sell their infra assets, which is the roads and solar assets, in the next 2 months to pay a large sum of the remaining amount, which is nearly 7,000 odd crores, which they have to pay to the lenders. And that's a very Herculean task, in my opinion, because we know for a fact that infra assets cannot be sold in 2 months' time, especially when they don't even have a binding agreement with some of the players there. Z claims that they've been in talks for 8 months, but 8 months they've been in talks to get the final valuation part of it. Binding agreement has to be signed, and that after the signing of the binding agreement is when the entire closure takes up to 6 to 8 months. So in my opinion, by September end, it is unlikely that they will be able to complete the sale of non-media assets.
So what happens?
So they have no other way but to sell Z shares going forward as well. They already sold 11% to Oppenheimer. Oppenheimer is not going to come again for the rescue, because they've hit the ceiling as far as Oppenheimer is concerned, and that's what Z's Puneet Goenka told us, that when I asked him that why did you sell only 11%, not more than that, they said Oppenheimer has restrictions of investing beyond that. There are internal rules and regulations which prevent them from investing more than 11% in it, and that takes the entire exposure of Oppenheimer to nearly 19%. So that's almost $1 billion stake they have in
Z already. So I have a fundamental question, Sajid. They took this long to get one investor who is an existing investor to put in 4,200 crores. What's the confidence that they can give to the market that if the other things don't work out, they'll be able to get another investor in Z itself in a period of less than 2 months?
So I'm sure they're going to open the back channel to for a financial investor again, because next stake, if it happens and if the non-media stake doesn't go through, they would have to sell close to 15% to pay off the mutual fund and the NBFC guys, and that would mean that they will end up with some 10% or 11% stake in the company going forward, and that's going to be a tough ask for the promoters, because promoters will be controlling the stake, but be sure that they are open to easy acquisition or takeover targets going forward, and they're not, and it will be very difficult for them to ward off. It's going to be a classic Mindtree thing where the existing promoters will hold around 10-11%, and they think that Oppenheimer with 18% will back them up, though they say there is no agreement with Oppenheimer in any form, because there is a pure equity thing. But Oppenheimer will sell his stake if it gets a bigger, if it gets a better return there. So that's going to be a tough ask, and all the reports which are coming in, they're saying it's a short-term positive because it takes off just 40% of the entire liabilities. But what happens to the 60% of the liabilities? The Z Group is trying to say that once the non-media assets are sold, there will be minimum amount of marginal stake which they have to sell of Z to ensure that 11,000 crores is reached. But now that's not, that's going to be a tough ask.
Okay. Now, before I get to what mutual funds will benefit, since Sajid brought up this topic of what brokerages are saying, I just want to give out people two views, because this pertains to Z Entertainment, the stock. Axis Capital and Bank of America Merrill Lynch, I think they've given out the most pertinent views with regards to this deal. Axis Capital says that while the deal is a step in the right direction, the overhang on the stock remains, as the promoters will have to complete the sale of other assets within a stiff deadline and may have to sell additional stake in Z to address the possible shortfall. They expect the stock to remain sideways over the next few months till further clarity emerges on asset sale and shortfall funding. Bank of America Merrill Lynch is a lot more circumspect. They say that the market they believe that the market may be disappointed with Z going along with a financial investor versus a strategic investor. This is because, according to them, and they point out that the Z management in November had stated that it needed a global strategic partner to maximize long-term value and transform Z into a global tech player. Also, the market would likely await clarity on other non-media deals, as the $65 billion rupees plus debt still needs to be repaid before September 19th. So all the points that Sajid maintained are the reasons why some of the brokerages are disappointed. But Sajid,
strategic sale is not going to happen.
Not going to happen.
It's off the table. That's what he told.
Yeah.
I asked him that, and
I
he
saw the
said
headline.
Yeah.
I saw your tweet as well, by the way.
Yeah. So he said very clearly, strategic is off the table, and I'm not sure why he said that, because he said in October, November about the fact that this is going to we want to make it a global tech company. But at that time, he also mentioned the con call that two events happened. One is a Jan 25th Black Friday event, which led to the stock falling 30%, and then the elections, which led.
So things have changed.
So things have changed. But point is that if he's in talks with the strategic investor from November onwards,
why didn't it happen? Yeah, sure. Get your point.
It's a valuation question which is coming in. Yeah.
Maybe. And let's hear out the management as they speak about this particular thing. Puneet Goenka rules out a strategic stake sale for the time being.
For the time being, strategic investor is off the table because, again, just to reiterate, as I said, if we have to meet the September 30th deadline with the lenders, and we know for certain that we will not be able to close a transaction with a strategic investor, and therefore we have to go with a financial investor only.
Okay, now the other question, and very quickly, what do mutual funds which hold the pledge stake get from this deal, Sajid?
So the waterfall is in this fashion, and this is what we got from the speaking to some of the mutual funds, that whatever you got 4,000 odd crores, that will be divided proportionately to all the investors who will basically have debt securities backed by Z shares only. So only those investors will get the money who have Z security as collateral for their debt. No other investor with either Dish or City Cable is is going to get anything. So it's going to be a proportionate sale as of now, but it requires an escrow mechanism, as Goenka told us, that those securities have to be agreed and pulled into an escrow account, and there will be a common escrow agent which will be agreed upon, and Oppenheimer will have to transfer the fund into the escrow account for it to be given proportionately to all the investors.
Okay. Sajid, thanks so much for putting all of this into perspective, and we'll talk about this deal a bit later on as well on Indian Open at 9:30, so do stay tuned for that. The next piece on First Word is about autos. Now, the slowdowns hit one of those auto companies, which is Eicher Motors, very, very hard. The truck-to-bike maker failed to meet estimates in the first quarter, despite analysts factoring in lower sales. Discounting meant that margins also took a hit. Yatin Mota is here to take us through those details. Yatin, morning.
Morning, Neeraj, and Eicher Motors numbers slightly below estimates, especially on the operating front. If you look at Eicher Motors, the overall revenues were down nearly 6.5% to come in at 2,381 crores, broadly in line with expectations. However, if you look at the absolute EBITDA, that came in at 615 crores versus our expectation of close to 650 crores. So, almost a 5% kind of a miss as far as the EBITDA is concerned, and that is clearly impacting the profit growth here. Also, if you look at the profit versus the estimates, it was 451 crores versus the poll of close to 490 crores. Margins also came in at 25.8% versus a level of 31.8. So a 6% decline on a year-on-year basis is what we saw for Eicher Motors as far as the margin performance is concerned. The expectation was 27.2. Of course, this time the other income supported the overall profit at this point in time. Employee costs were up 24% during the quarter, because of which there was pressure on the overall operating capacities as well as profitability for Eicher Motors on a consolidated basis. As far as Royal Enfield is concerned, remember the volumes were down 19% for them, and clearly because of that decline in Royal Enfield volumes, the consolidated performance has been quite weak for the quarter.
Okay, and what do brokerages have to say about the results, Yatin?
So Neeraj, if you look at the management on the conference call, post that brokerages have cut the earnings estimates. Management clearly said that the demand environment is challenging. However, the silver lining is that the monsoon is moving good. More importantly, the festive season will start helping the volumes moving ahead, probably from September. This is something common which all of the managements have said so far, that August, September is where they are expecting some kind of improvement in the overall volumes. As far as brokerages are concerned, CLSA has maintained a outperform rating. However, they've cut the target price to 19,000 versus the earlier target price of 21,000. They have cut the EPS estimates for FY20 and 21 by 6 to 7%, respectively, on lower Royal Enfield volumes and commercial vehicle volumes. UBS has maintained a sell. They have cut the target price further by 600 rupees to a target of 15,200. They expect domestic volumes to decline by 10% for Royal Enfield. Probably that is the reason why they have put a sell call on that one. Morgan Stanley, one of the brokerages which tracks the stock well, has maintained an equal weight, cut the target price to a steep 17,052 from a level of 21,331. They have cut the FY20 EPS estimates by a steep 17% to capture in lower volumes as well as lower margins for the Royal Enfield business as well as VECV commercial.
Okay, Yatin, thanks so much for putting that into perspective. But lowered estimates and the company still missed those. So that should probably act as an overhang. Yatin, thanks so much for putting that into perspective. And remember, it's a busy day for autos. The numbers start trickling in, so we'll be watching out for that as well. The last piece on First Word is the government's aim of water for all by 2022. But the market angle to it, it can create a multi-billion-dollar deal or can create multi-billion-dollar deals for companies with the correct know-how. While previous projects have made little headway, the allocation made in a budget has reignited hope amongst investors and companies alike. So which players stand to gain from this proposed spend? Nikki has some answers. Nikki, morning.
Morning, Neeraj. The whole water infra as a theme garnered a lot of attention post the budget when the budget actually allocated an 81% higher spend in pipe water supply segment. That's where the whole traction came in from. Looking at the billion-dollar opportunity, it's a $270 billion opportunity which Bank of America Merrill Lynch has put and divided that across 4 existing schemes in the whole segment as a whole. River linking, which is it sees that as a $160 billion opportunity, or for that matter, rupees 18,360 billion. What is river linking here? It's just to create inland waterways. Pipe water supply, another big opportunity coming up from that basket. $94 billion PMKSY, that's Pradhan Mantri Krishan Sanchai Yojana scheme. Now that is pegged as a $4.5 billion opportunity, where it's nothing just to boost irrigation, where we know that India as a whole has 2/3 of farmland coming in from monsoon. So clearly irrigation is a boost out here. Namami Gange, which is a $3 billion opportunity, nothing but cleanup of the rivers out there. Coming back to essential point, where does this $270 billion opportunity actually goes to? Which are the sectors which stand to benefit from this move? Namami Gange, if and when this scheme completely comes into execution, you will have all the EPC contractors, especially in sewage treatment, which would benefit from this. River interlinking will also have EPC contractors in the irrigation segment, which could take the benefit. PMKSY would be a mix of both, that is EPC contractors, the micro irrigation companies, something like a Jain Irrigation, HDPE pipe manufacturers, which again would stand to get benefit. In the similar way, pipe water supply is nothing but the same combination, permutation of EPC pipe players, and along with that some cement players. If I would just suppose to pinpoint or pick up few stocks which will stand to gain from the execution of water infra scheme, we have all the construction companies in list there. We have L&T, we have KNR Construction, we have Nagarjuna Construction, Satpav Engineering. And for pipe makers, it's a blend of two, the steel makers as well as the HDPE pipe makers, where you have Astral, Stream Industrial, Jindal Saw, Tata Metallics. But let's address the ground realities of this scheme. Let's actually understand how much has been done for this until now. We're saying that it's a $270 billion opportunity, but then we've just spent a little over 68,000 crores so far in the span of good 5 years. If you could pull up the chart out there, we have seen allocation increasing only for rural drinking water, where that sum is going up from 4,370 crore to 10,000 odd crore. That's where the thrust lies. But net-net, if you see on the broader front, it's just a 68,000 crore being spent for an opportunity which is as big as 18,360 billion. Clearly, we're lacking out on funds, and there needs to be more push coming in both from the government as well as states to make this plan, which is a whiteboard plan until now, ground reality. What we essentially also have to point out is the fact that the capex share of government for these water and sanitization schemes from 2003 until now have actually reduced to 12%, from 12% to 9%. So that's clearly reduction coming in despite the kind of thrust and the noise that have been made around these schemes. What we also need to do is set up a tariff for water supply where the 14th Commission has said that they could charge the states could charge a little over 30 to 70 rupees from every household for every month. Building political consensus is also essential. A proper roadmap from Jal Ministry, which is a new ministry which is now being formed. Segment of all the water streams under that will particularly come in this ministry, and there is a need of PPP models because the kind of funds that this scheme would require would be huge for that matter. So it's a good whiteboard plan. Execution will take some time, maybe 2-3 years according to players, as and when it happens. But a lot of work needs to be done around this for making this an ground reality.
Okay, Nikki, thanks so much for putting that into perspective. And that's all that we have on First Word today. Lots more lined up on Indian Open, though. We discuss markets and macros with Saurav Mukherjee of Marcellus Investment Managers, talk about the Z Entertainment stake sale with Anil Singhvi of ICANN Investment Advisors, and find out when we can expect a recovery in auto sales from VS Parthasarthi of Mahindra & Mahindra. But after this break, a full tilt towards the day's trade.